AAT sample assessment number 1, PNTA personal tax, task 6. So quite a tricky task, 8 marks, about tax planning. You really have to apply your knowledge here, can be on a range of different topics. You work for a firm of accountants. Several clients have recently contacted you about ways in which they can minimise their tax liability. Complete the following sentences. Enter your answers in whole pounds and zero if needed. Dr. Yu has total income of 110,320. He currently pays £300 per month into a private pension. He wants to know how much more he needs to pay into his private pension scheme to protect his full personal allowance. Right, okay, so how would we approach this? So we need to basically not have any excess over 100,000. So that means that he's got to pay, we've got to get rid of 10,320. So I'm just having a think here. Yeah, sorry, I was thinking about half the excess, but it's irrelevant, isn't it? Because we're basically trying to wipe out any excess, as we haven't even got to do the half the excess calculation. So we need his private pension contributions, his gross private pension contributions, to be equal to 10,320. Now that's his gross. So we then need to convert that gross figure back to his net contributions, because it's asking us about how much he's going to pay. So that would be the net amount. So if the gross is 10,320, if we work out what 80% of that is, then that will give us the net figure. So the net figure will be 8,256. Yeah, 80% of the 10,320. So 8,256 has to be paid to protect fully his personal allowance. He's currently paying 300 per month. So 300 times 12 is 3,600. So if he's paying 3,600 and he needs to be paying 8,256, the difference between those two figures, which is 4,656, is the extra that he has to pay. All right, so quite a challenging question, that one, I think. Ms. Q, a higher rate taxpayer, was provided with a company car for the whole of 21-22. The car was registered on the 1st of January 21. The cost of the car was 36,200 and the taxable benefit is 7,964. It was a diesel and it did not meet the standards. So we know that if it had met the standard, or if it was a petrol vehicle, the percentage used would have been 4% less. Ms. Q wants to know how much tax she could have saved if she had been provided with a car with a petrol instead of diesel engine, assuming everything else remains the same. Right, now there's probably a shorter way of doing this, but this is how I thought about it. So I started by working out what percentage must have been applied. So if we know that the benefit is 7,964 and the vehicle was 36,200, if you do 7,964 divide by the 36,200, you get 0.22. So your percentage must have been 22% when it was a diesel car. So we know that that's 4% higher than if it was a petrol car. So therefore, for a petrol car, the percentage would have become 18%. So then if I do 18% times the 36,200, I would get a new taxable benefit figure of 6,516. Right, so it was 7,964, it's now 6,516. So that is a difference in the taxable value of 1,448. But it doesn't stop there. The question's asking how much tax she would have saved, and she's a higher rate taxpayer. So if the taxable amount is dropped by 1,448 and she's a higher rate taxpayer, that means that she will save tax on 40% applied to that 1,448. So 40% of 1,448 is 579. Mr. X, a higher rate taxpayer, has inherited £50,000. He currently has no investment income and wants to invest the money in the most tax efficient way. Mr. X has looked into different investment options and has decided he does not want to invest in shares. All right, so we're looking at savings accounts. He wants to know how much tax he will pay if he decides to invest all the money with his local building society in the most tax efficient way. All investments make an annual return of 2%. Right, so I'm thinking ISA, individual savings account. He's got 50,000. He's got no investment income at the moment. So therefore, if we go to our reference material and we look at individual savings accounts, we can see the limit is £20,000. So I'm going to suggest he puts £20,000 into an ISA, and we know that the savings from that are tax-free. So that leaves him with 30,000 that he just has to put in a normal savings account. So if he's getting 2% interest on £30,000, that comes to £600 altogether for the year, £600. He's a higher rate taxpayer. We know that higher rate taxpayers get a 500 savings allowance. So if he's got £600 of interest, 500 will be at 0%. So he's going to end up paying 40% tax on just the other £100. So 40% of 100, being asked what the tax liability is, would be £40. And finally, Mrs. B has been offered a loan from her employer of £12,000. So I'm thinking it's over 10,000, it's going to be taxed. This is the only loan she has had from her employer. The terms of the loan are that she does not need to pay the loan back for 5 years and she needs to pay no interest. Mrs. B is worried that the loan will have tax implications. You tell her that if she accepts a loan of how much less than the offer, she will pay no tax. Right, so we know that a loan up to and including £10,000, so if she accepts £2,000 less, she would pay no tax. If she accepts, there's a typo there, a loan of £12,000 and pays interest of at least what percent, she will pay no tax. Well, we know we only have a benefit if we are paying below the official rate of interest. We know, and we can check if we've forgotten, that the official rate of interest is 2%. So if she pays 2% interest, there is no benefit, and therefore there would be no tax.